continued focus on financials there. Saurabh Mukherjea also joining us this morning. Saurabh, good to have you with us as always. Now, you've maintained, your stance since the beginning of the pandemic and its implications on stock markets, Saurabh, and you've been looking at select names that you thought would be resilient through this. I still want to get a perspective from you, though, because considering that the pandemic seems to be lasting a lot longer than that was anticipated, are you still perhaps looking at the pain that might actually now be a lot worse for some companies? Is that something that you would now factor in, really, given that you've actually said all this while that pockets will continue to be resilient?
I think on that front, right, this whole pain front, it's relatively clear what the sort of pecking order is. So, for example, on essential products, if you look at Nestle or ITC sales, they're pretty much back to normal, right? If you go up to, say, one notch up from essentials or semi-essential stuff like undergarments and paints and adhesives, you're back to 70-80% of normal levels, right? It's only in sectors like trucks and cars that normality is still some distance away. And even in that sector, in the auto sector, two-wheelers, as you folks were just discussing, two-wheelers seems to be back to 80% of normal demand. And even tractors, I think one of your colleagues was just mentioning tractor demand is roaring across the country. So it's not clear to me that the pain is as acute as people felt it would be 3 months ago. Obviously, given the scale of the pandemic, there are sectors with demand deficiencies, but the pain is a lot less acute. And most importantly, perhaps, every week you have one global central bank or the other saying, we will give you free money for the next 2 years. If you have this sort of monetary support week after week, month after month, it's very difficult to pull the market back. If central banks have printed the best part of $9 trillion in the last 3 months or so, and they're promising to do more, it's very difficult to pull the market back, regardless of how adverse the underlying economic news will be. And ironically, the underlying economic news isn't anything as adverse as people were fearing 3 months back.
Yeah. Saurabh, hi, morning. I was just talking about tractors. It's a limited space. There's only Escorts and M&M. But do you think when it comes to cases like M&M, the other businesses may drag, whereas tractors may continue to hold higher, and in that sense may act as a bit of a resistance on the stock or the story?
I think I buy your point on the fact that tractors itself is not a large sector, but I think the broader point that's coming out from, say, a variety of data points, whether it's, say, Parlay's demand or several companies commenting on the robustness of rural demand, two-wheeler companies are talking about it. I think Pawan Munjal Saab at Hero has pointed out that two-wheeler demand is coming back strongly rural. I think the fact seems to be that rural is stepping into the void. Clearly, the COVID hit for rural India is weaker. And hence, in that broader context of demand shifting from urban to rural, demand shifting from, say, us going out and eating in restaurants to spending money on OTT, COVID is leading to some demand shifts. The overall economy obviously has struggled through the lockdown. But as we gradually go into the unlock world, there are some demand shifts, and perhaps the most striking of these is the resurgence of rural India as COVID hits them less and the government's relief program benefits rural India. On the point of M&M, I agree with you. I think there are broader challenges in the firm, and hence I'm not sure I will be rushing to buy M&M just because I want tractor exposure.
Sure. Any other crushing story in the market that you may be observing, keeping on your radar, or are already buying, Saurabh?
So I think we have to confess, in some of our clients' portfolios, we have bought Maruti after a long time. I think after 3 years, we bought Maruti in some of our clients' portfolios. Broadly on the same story, our reckoning is, the car sector, the passenger vehicle sector, will consolidate around basically Maruti Toyota as one consortium and Hyundai Kia as the other. I think everybody else pretty much is now irrelevant. And if you have a two-player market, and this is very similar to what I've discussed on your channel over lots of years, right? If you have two strong players, strong barriers to entry now around these two strong players. And of them, Maruti caters to the lower end of the market, the cheaper segment of the car market. I think the industry structure becomes very, very attractive. I don't see sort of mad discounting in the passenger vehicle market. And as rural comes through, as the interest rate cuts come through, I think Maruti should be in a good place. So in some of our clients' portfolios, we have bought Maruti. The other striking, I think, trend is in the financial services sector. The very sharp divergence in the cost of money between AAA rated lenders and AA rated lenders. I haven't seen in my career this sort of gulf in the cost of money. So I think we'll see a very sharp polarization where the top lenders, whether they be banks or NBFCs, I think the top 3-4 banks and the top 3-4 NBFCs will very sharply pull away from the rest. The rest will struggle to get access to funding, and the top 3 or 4 will see NIM expansion and loan book expansion as we go towards the end of the current fiscal.
Saurabh, the banks which have raised capital, that includes Kotak. Axis has announced last evening. ICICI Bank has stated the intention a couple of days ago. Now my question is that these are 3 banks which do not need, frankly, capital. If you're raising capital when stocks are not at an all-time high, which means you are protecting your balance sheet or strengthening your balance sheet. Now when banks are saying that, look, we need to raise capital where generally stocks are not an all-time high, is this a signal that they are worried about NPA cycle? Because in a bull market, if they would have raised capital, we would have called it growth capital. But in an economy like this, when they are raising capital, when you're generally flushed with tier 1 and liquidity, is this survival capital?
So I think, look, everybody's worried. Even I'm worried. We don't know when we come out of these 180-day moratoriums. We don't know how big the NPA hit will be. It is but inevitable, right? It is but inevitable given what we are seeing in the country around us, that several companies who have gone into moratorium, those businesses might never reopen, right? So, restaurants, cinema halls, there will be big parts of the economy where the companies that have taken up moratorium might never reopen. So I think the smart lenders are saying, and as you highlighted, the smart banks are figuring out that rather than my waiting for the moratorium to end and then writing off part of my tier 1 and then, going to raise capital, let me raise capital preemptively. And I think that will be the smart strategy throughout the next 3 or 4 months before the moratorium ends. Go and raise capital. That being said, what we are hearing from several banks, right, from Axis Bank, I think we've heard from DCB Bank, we've heard from Bajaj Finance, it is relatively clear that the quantum of loans in moratorium is reducing. And although the quantum of loans in moratorium is reducing as some businesses pull out of the moratorium, it's relatively clear that when the moratorium ends, there will be a significant chunk of that pool which will NPA out. And I think therefore the stronger lenders who've got good credibility in the investor community are saying, let's push the capital raising trigger now. That in turn becomes another driver of consolidation. The weaker lenders will not be able to raise capital, whether it's equity capital or debt capital. The stronger lenders are able to do so, and thus you consolidate the lending sector, just like we discussed, the passenger vehicle sector is almost consolidated out, telecom consolidated out the next 3-4 years, and that trend continues in our country. Mega sectors end up in the hands of a small number of providers.
Fair point. But if banks are cautious, and that is the canary in a coal mine, if I may use that phrase, of economic activity. If banks are not lending and if there is surplus liquidity which is parked with RBI, isn't that an underlying indication of that economic recovery is going to be weak and fragile?
So the bank's caution is also a mixed bag. So if you see HDFC Bank, they are saying disbursements are back to January levels, right? So I was speaking to you on one of the smaller banks, right? One of the smaller banks in South India. They too are saying disbursements are back to January levels. And what all the banks have been helped by is the scheme which the FM announced a month or so back, or 6 weeks back, where she said that a 3.5 trillion scheme where you as a lender can give a top up to an MSME, any company with a turnover of 100 crores or less can borrow another 20% extra, 20% of their current facility they can borrow extra. So that facility, I think, has proved to be very handy. Remember, the government of India is underwriting that facility. So I think smart lenders are taking advantage of that to get their disbursements going. And I mean, honestly, if in June, disbursements for several credible lenders are back to January levels, it's not apparent to me that out there's a massive credit crunch, right? HDFC Bank is a large bank. Other credible lenders are also saying disbursements back to Jan levels. So I'm not so sure there's a credit crunch as yet. Yes, I'm completely with you that there's no capex cycle to talk about. There might not be for another 6 months. But if this whole shift of production from China to India, both in terms of global supply chains tilting from China to India, and obviously in terms of our own demand, the $70 billion of stuff that we buy from China, if we start making that in India, that potentially gives you the trigger for the next capex surge. That is probably 6 months out as we wait for the world to settle down a little bit more, as we wait for the pandemic to settle down a little more. But at the moment, working capital, there seems to be abundant availability of the same on the back of the government scheme from 6 weeks ago.
Okay. Saurabh, is it still too early to start fishing in broader markets? We've got the odd report trickling in now suggesting it may be the right time, possibly also on the FOMO effect, wanting to kind of get in while they still can. What would you say?
Look, I think we've articulated this as clearly as we can over several years now. What we have created is an economy where in almost every credible sector, every large sector, every significant sector, 80-85% of the profits are ending up in the hands of a very small number, 1, 2, 3 companies, right? If you want to go and fish around, I mean, it's your money, you can do what you want. But my reading is what we have seen in the last decade or so will continue, which is around 20-25 companies in India will chug out 20% earnings growth, and the rest of the corporate world will grow earnings at 1 or 2%. That, by the way, is the real data for the last 10 years. I'm not making it up. Last 10 years, we've seen 20-25 powerhouse companies grow earnings in high teens, low 20s, and the rest of India Inc. has grown earnings at 1% per annum. So if you feel lucky, you can go out and fish around. But I don't feel so lucky. I feel I have to be conservative. I have to be prudent with my money and other people's money. And hence we will focus on powerhouse players, whether it's in auto, we discussed a couple of names, whether it's in banking, and whether it's in the traditional sectors that we've loved for a long time, paints and adhesives and so on. So I'm not so sure going and fishing around should be anything other than a hobby. If I want fish, I'll ask a professional fisherman rather than having a punt myself.
Fair enough. Saurabh, there is what to you would be the most likely risk at this point of time? We're entering into a period where we're seeing recovery, we're seeing an unlocking, but all kinds of global dynamics still playing out. While we may still be better placed in terms of, one of the EMs that's still relatively better placed, what would you say, would be the major risk factors that continue to hover at this point of time?
I think there's two that are worrying us, and we're hearing a lot about these two from companies. One is the labor shortage, right? So it's clear that already in parts of the auto sector in Gurgaon, Manesar, there is a labor shortage. We are also hearing about labor shortages in the travel, in the transport sector, truck driver shortages. How will this get more acute? Will this alleviate? I don't know. But if labor shortages become more acute as we go towards the festive season, and that is really worrisome because that could create a trigger for wage inflation. And the last thing we need at the moment is wage inflation to go through, because that in turn will drive up CPI inflation. The second is the supply chains which originate in China, right? We're reading in the newspapers about stuff being held up in ports, both in Hong Kong or in the Chinese side or in India. And obviously, as the hostilities potentially increase, will those supply chains break down? So a big part of, say, components for the auto sector, APIs for the pharma sector originate in China. So if global supply chains break down and India's supply chain with China breaks down, that has ramifications for our economy, which I don't think we fully understand at this juncture. These are the two main things worrying us. I don't think demand per se or the pandemic or monetary policy are that big a deal at the moment. These are the two non-linearities. Will labor come back to the industrial zones of our country, and will the supply chains with China break down as hostilities potentially escalate in Ladakh?
Sure. Where are the contra opportunities, Saurabh, in this market?
I think this the place where we're very, very keen to do more work is just that it is a complex sector. Is what we are hearing from pharma experts in America and buyers in America is that the sheer scale of the Chinese API market is such that there is a clear desire on the part of global pharma companies to reduce their dependence on Chinese API. So even if 5% of the Chinese API production moves to India, India's API demand doubles, API production doubles. India's API production doubles, which is 5% of the Chinese market migrates to India. Now, if India's API production doubles, there's a whole kind of supply chain of chemical intermediates, down to raw chemicals, then glass line vessels, right? There's a whole ecosystem there, right? That we would love to understand in more detail. And a lot of these are listed companies, small cap, mid cap listed companies. The chemistry is a little complex, and unfortunately, not that many of us in the team have chemical engineering degrees. So there's a little bit of chemical complexity. But the other thing is, this is a completely new world, right? Our API sector has actually shrunk in the last 20 years. So to potentially look forward to the doubling of API production in India over 3, 4, 5 years is something very exciting. And my reading is there will be plenty of money to be made here. Just a question of doing some diligent research on not just the straightforward part. The straightforward part is Divi's lab makes API and they grow. That's easy. But who supplies Divi's lab? What are the intermediate suppliers? What are the machinery suppliers to the sector? And I think there's potentially a whole ecosystem that will blossom there as the world reduces its dependence on Chinese API production.
Saurabh, is it a good idea now to start looking at deep cyclicals now? I know the whole government ownership angle is something which is a big bogey there. I know the competitive advantage of Coal India and the BHEL has got diluted. But sometimes you say that when you buy a stock, you need to figure out what is in the price. If you buy a BHEL or a BEL or Engineers India, these are companies which have no debt, strong dividend yield, and they are available at throwaway prices. You know, it's like saying that suddenly gold is available at the price of not even silver but rusted iron.
So look, I mean, I always sort of, we've always agonized about the valuation, the cheapness of the valuation alongside, say, that the deep competitive advantages of a BHEL and a Coal India versus the fact that their main master is not the private sector shareholder. Their main master is the government of India, and especially going into a juncture like the one we're potentially heading into, where cross-border hostilities would increase, where there is a pandemic raging. It'll be a little unrealistic for us to buy these shares, expecting them to serve the needs of us as minority shareholders. Their main master, the main master of the PSU companies is rightly the government of India. And therefore, these PSUs have to serve the needs of the nation, not my needs as a minority shareholder. And therefore, if that is the case, I can buy them as an act of patriotism. I can buy PSU stocks as an act of patriotism, but I shouldn't be buying them as a fund manager managing other people's money. There are two distinct facets to it. If I'm a patriot and I want to support my country, then buying PSU stocks would be one way of showing that. But I shouldn't be buying them expecting them to give me returns returns well above my cost of capital. I think that's the distinction I would love to draw. Great companies, great franchises, but they're not there to make money for minority shareholders.
Between HDFC Bank and HDFC Limited, they both are formidable franchise. One is a bank, second one is a Cleon mortgage business. The banking space will get consolidated and the HFC space has already got consolidated. Which one would you buy for the long haul? Next 5 years, if you have to, let's say, choose between HDFC Limited and HDFC Bank?
That's a lovely question. So I think what's very interesting about the HDFC franchise is the ability to build massive scale plays of great quality, great brands, and whether it's HDFC Asset, whether it's HDFC Life, whether it's the bank. And I think that really makes HDFC as a franchise unique. I don't think any other financial services conglomerate in India has enjoyed this sort of ability to build mass scale franchise after the other. And to the extent that the parent gives you a play on life, on asset, and 20% of the bank, then the parent does become attractive. Where I think HDFC Bank, as a comparative franchise, is a superb places. The market share in Indian banking is all but 6%. Unless some unforeseen disaster fructifies, the market share should easily be touching 10% a decade hence as the PSU banks wither away. HDFC Bank has given 270x in the last 24 years, 25 years. So 10x in 10 years, 270x in 24, 25 years roughly. If market share goes from 6 to 10%, which I think is all but assured, HDFC Bank is as close to a guaranteed bet you get on 8-9x returns over the next decade. Very difficult for a fund manager to walk away from relatively clear sideline onto 20% returns over 10 years. And hence, just on a safety perspective, HDFC Bank will stay a big part of our portfolio.
All right, Saurabh, we'll leave it there. Thanks so much for joining us and speak to you again soon.